Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson, and joining the show today is Stephanie Copeland, managing partner at 4Points Funding. She joins us today from Denver, Colorado. Stephanie, it's great to get you back on the show. Thanks for coming on. How you doing?
Good. Thanks, Jimmy. Thanks for having us again. It's been a couple years and lots have happened between them. I'm looking forward to talking about that.
Yeah, absolutely. A lot's transpired over the last couple of years since you and your partner, Chris Montgomery, did an Opportunity DB webinar. One of the first ones we ever did, actually, a couple of years back,
Right.
early in 2020. And you were also on the podcast back then. So it's great to have you back on the Opportunity DB platform and the Opportunity Zones podcast. I'll be sure to link to previous 4Points Funding appearances in the show notes for today's episode. You can find those at opportunitydb.com/podcast. But Stephanie, for now, let's dive in. So we're 4 years now into the Opportunity Zones tax policy. What has 4Points Funding accomplished in those first 4 years? I know you have been up to a lot of work over there in Colorado.
Yeah, it's you know, going the last 4 years we spent kind of a mixed bag of time doing the things that you have to do with an opportunity zone fund. One is fundraising, the second is identifying really high quality and particularly high quality for this particular equity type investments. And third is a lot of education. So we have actually invested about $80 million of equity across the more nascent part, the more out, rural parts of Colorado, thematically in multifamily housing. So we've got about 1 million square feet under development. We actually, as of this quarter, we have 385 units that are operational. So that we've retired some of that square feet under development and moved them into operations. And we've also invested in about 7 campsites, which sound like kind of non-adjacent investment opportunities. But we found is that if we're already in a market, being in the market with another kind of real estate backed operating business makes a lot of good sense for the team with regard to synergy. So we've got about 7 campsites, all are up and running, operational. We've done a lot of development there, and they're doing quite well. And I think you say it's been 4 years. I think the pandemic has both made it kind of 30 seconds, but also, on the one hand, it feels like it's been 30 seconds or less than a year ago. On the one hand, it feels like it's been decades. So we're pretty proud of putting this all to work, but we've got a lot of hard work in front of us.
Sure. No, it's great that you've got those few hundred units already operational and online. It's that's been a really neat part about covering this industry since I guess about middle of 2018 is when Opportunity DB came into existence. Nothing had been built by then. Everybody was just starting to pencil in the projections and having different fundraising efforts for projects far out into the future. And now we're actually kind of seeing a lot of these units, a lot of these properties and projects all across the country actually get stabilized and leased up,
Right.
which is great to see. So another great success story for Opportunity Zones from
Yeah.
4Points Funding. As far as Opportunity Zones as a whole go, just the entire tax policy, the incentive, whatever you want to call it, what lessons have you learned? I know you probably had some perceptions
Yeah.
going into what you were doing at 4Points Funding. Have any of those perceptions been confirmed, or what has been debunked in the intervening 4 years since the tax policy was first rolled out?
Sure. We didn't really know yet how investors were going to think about the opportunity zone rules for them as investors vis-a-vis the different timing of investments that would come into play. Meaning, we initially thought we were going to roll out a series of funds every 6 months. And we did that because we thought, our investors would want to be only 6 months apart from any other investor in the fund, meaning, because of the timing, how long the whole period for opportunity zone investments really starts the last day, the last dollar goes into the investment / into the fund. And so that was our first kind of thought. we ended up ditching that thought pretty quickly because it's just too laborious and it distracts too much from the actual development that you need to do, putting the money to work. And so we moved to kind of vintage year funds. So that was kind of the first thing I would say. We were wrong. We pivoted quickly, and now we're in the middle of raising our fifth fund, which will be for the cohort of 2023. And that really was a guess based on investor reaction. We now have a lot of data on how investors are really thinking about this and how really what their tolerance level is for hold periods. The second thing I would say that has really been confirmed is thematically, we just knew that we could go find nascent areas of demand and use the opportunity zone investments, both create outsized returns, but also impact positively a problem in some of these smaller communities we're having, which is, of course, and it's been in the headlines for a number of years now, the lack of housing. And I'll use the small a, affordable housing, meaning not affordable as defined by the government, but affordable to the income levels that are in that community. And so we build to about the median income. That's the product type that we build. We don't try to lead the market in pricing. We don't try to compete with subsidized housing. We're kind of in that middle area. And we thought there was a real pent up demand for that. And that's certainly been borne out. And we think that that's going to continue to be an opportunity, although navigating that in the backdrop that we're sitting in today is a little more tricky than it was when debt was essentially free. Your cost of capital outside of equity was very, very low.
Right. Well, I want to shift gears and talk about the economic backdrop that we're facing right now in this country and really worldwide. But
right.
We're in a bear market. The broader equities markets are down, between, call it 20 and 30% since the beginning of the year. Very high inflation and also rapidly rising interest rates. What impact does all of this have on opportunity zones?
What was with when opportunity zones were enacted, we knew it would take some time for the market to really understand them and to create kind of a systematic approach to opportunity zones where people said, okay, you have to improve, the investment by 1x. You have to do certain things that really lends opportunity zone investments to greenfield development, kind of de novo high growth development, because you can't just invest and you can't park capital. You really have capital has to be capitalizing. And in a backdrop where it's taken, 4 or 5 years, frankly, a couple of years to even get the rules out, and then a few years, to really form the market, people were just getting used to thinking about returns and how much the incentive added to the return and what the real benefit was. So two things the economic backdrop is doing that are kind of most top of mind for me. One is when people are losing money in the stock market, they're less likely to think about where they're going to put their capital gains because there just aren't as many in period, in the time. That doesn't mean there isn't plenty of liquidity sitting on the sidelines. It's just a sentiment issue. And it certainly becomes a different conversation. And that's a whole new conversation that's starting up. The second thing is when you're underwriting deals and you've gotten used to a certain cost of capital, and in fact, your deals that you underwrote a few years ago expected a particular refinance rate once it was stabilized, that's been blown up. And so you're looking at yield on costs relative to treasuries. You're looking at all kinds of debt service coverage ratios that you never thought you'd have to contemplate because your cost of capital has gone up in such a short period of time so dramatically. And I think there are so many people that believe, or the conversations I'm in are always debating, when is it going to come back down? I think you have to get to the point where you're saying, I don't know that it will. And we might necessarily be in this kind of spike we're in right now, but I think we're going to have to get used to a normalized rate that's higher than what we've been used to in the past decade and a half.
The industry really got spoiled, right? With a very low interest rate environment for, a decade or more. I mean, it was actually not very natural for interest rates to be that low for that long.
That's right. And you have an environment that's kind of normalizing, not necessarily going out of normal, but it's
Hmm.
just done it very, very quickly. And so when you have business cases and underwriting that are set up on a certain expectation and that rug is pulled out from under you in the middle of your underwriting, it just means you have to look at things again from a different dimension. Now, there are two things that are at play, particularly when you're building in real estate. One is what's your cost of capital, and then is what's your cost of construction, all of those relative to the rents. So we've got these competing interests where obviously the higher the cost of capital, theoretically, the slower construction will be. That will take some time for that to get into the market and be reflected in lower pricing. And so right now we're still in the market with high rates and high pricing. So we don't have relief on either side. The only pressure point that you can pin then is rents. And rents have gone up so dramatically in the past several years that I'm not sure how much more room they have to go. In fact, they're coming down in many markets without starting to be super predatory and or really limiting demand. So right now, you're thinking about, you can't really take rents up more. You're not going to see 20, 30% rent increases in a year, most probably in the next couple of years. You've got a high cost of capital and you don't have construction pricing that is yet abated or at least slowing down in its increase. And so we're just seeing a lot of deals just fall out. And we're seeing a lot of deals, just people just slow way, way down. The unfortunate part of that is that limits supply. And when you have limited supply in these markets, you either have higher prices or people start leaving the market. And that is going to be kind of some perverse outcomes that exist, but I think from the Fed's perspective is worth it, and some of the pain that we're going to go through in order to slow down inflation. Um, and so I could wax poetic about that for a long time, but I think really what you have to do is make sure that whatever you're investing in, you have to look really deeply at a submarket level. Can you stress test the investment and make sure that it still holds up? Would you be happy with it in a multitude of scenarios, including an unlevered, completely unlevered scenario?
Right. Well, I found it really interesting. One of the last things you said there, the Fed is raising interest rates to combat inflation, but at least in the real estate development world, that might end up, constraining supply even further, which would drive housing costs up even more. So at least that part of the inflation calculation might be under some upward pressure for some time to come. I know it's kind of hard to contain all these issues that the Fed is trying to combat right now, and their primary cause or their primary purpose is to lower the general CPI. But it will be interesting to see how it affects the housing supply and the housing market going forward over the next several years. It's
Yeah.
certainly rather unprecedented what they're doing in terms of these huge 75 basis point in interest rate bumps over the last several months here.
And tightening money supply at the same time. I mean, you're
Yes.
theoretically doing that on both parts, but you've got in a again, I think all of us are just saying, gosh, we've got historically low unemployment rates, and there's all these things that will lag and can create so unemployment, the impacts of this will lag. That will happen later. Um, Construction pricing will come down, but that will happen later. And there's always a little bit of disconnection and dislocation in the market when you're going through this kind of pivot where you have things that shouldn't exist at the same time, but they do because you're going through this dislocation. And the other thing I would say is, when you think about renting versus owning, clearly ownership is getting more expensive until housing prices come down.
Mm-hmm.
And that will be, again, a sort of a long-term, more lagging indicator. I think for the next couple of years, we're going to have a lot of unwinding to do there. And then not to say what's the Fed going to do across a global backdrop, across that's facing in some ways different issues that we're facing. One of the things that I think has been super interesting is that we're going through inflation, and we have to acknowledge that so much of the inflation that we are experiencing has been on the supply side and not necessarily demand side. Now, we put a lot of stimulus in the economy and that created the demand side, but I truly believe that many of the drivers were on the supply side itself, at least from a core inflationary standpoint.
Yeah, I think the COVID pandemic and our response to it certainly didn't help matters there.
Correct.
Just to pick up one other thing you mentioned earlier, just kind of how this starting and stopping of the opportunity zone industry going forward. It took a couple years for the industry to get rules, regulations around the legislation, and then right when we had the regulations, we were interrupted by COVID, and then we started humming along again, and then this the economy kind of turned south. So it's kind of
Yeah.
been a several fits of starting and stopping since OZ's got going. But Stephanie, I'm curious to hear what is 4Points funding developing going forward. It sounds like most of what you're doing is median level income housing. I don't know if you might refer to that as workforce housing or lowercase a affordable housing. Are you
Yeah.
doing more of that going forward, or do you have anything else
No,
planned?
that's what we really like that backstop because we believe it sits core in the middle of where household formation is coming into play, and this kind of, you know, you'll have a constant in and outward amount of supply, or sorry, demand, just because people either moving into or up from affordable housing, or moving into um for sale or ownership. And so we are continuing to go down the path of little a affordable housing, workforce housing, middle income housing in these markets that we're going to. And the things that we look for in the markets are not necessarily, we want to be in non NFL markets. We want to be in markets that are adjacent, um, and have very, very clear infrastructure elements that will continue to attract population. So I want to make sure there is a good university nearby. There is like in the case of Colorado, we have a lot of resort adjacent communities that have a tremendous amount of need for workforce in the resorts, but not an affordability of housing and not an availability of affordable housing in those markets. And then I also want to see things like markets where you're fairly near a good airport, you're really close to good healthcare, et cetera. So we try to make sure we're not going, super remote, but we want to be kind of in the under radar emerging markets, particularly around Colorado as our population disperses outside of the core metro areas of Denver. Um,
Right. So in Colorado, what are some of those markets that you like?
so the a couple of markets that are our first two markets I really loved. We built in Grand Junction, which is on the furthermost western part of the
Mhm.
state, largest hospital between here and Salt Lake City, between Denver and Salt Lake, growing population, 11,000 student university there that is affiliated with the University of Colorado, Colorado Mesa University. Um, Big hospital system, big employer. Big airport as well, an expanding airport with many direct flights in and out on a very major thoroughfare, I-70 across the US. And so it has all of those kind of infrastructure backdrops. It also sits on some of the world-class mountain biking trails in the country/world, which draws a lot of people in, both from a visitation and eventually from wanting to live there. That economy is actually diversified quite a bit away from oil and gas into engineering, software, and other businesses that has also diversified the labor supply, which we really like. The second market is a different kind of market, but equally strong for the same reason. We think there's sustainable demand for the market, is a market kind of down valley from Aspen called Glenwood Springs, also off of I-70, very, very close, and creates a lot of workforce. It's a labor supply market into Aspen. And we built there right on top of the transit hub so that workforce could easily get up and down the valley to their work. And that market also has very little supply coming online, and so it's very difficult to build in the market, which we also like. The other markets are less known nationally, but we're building near Estes Park, which is at the base of Rocky Mountain National Park, 4 million visitors a year. We're building in Durango, which is this kind of oasis of very, very strong population migration coming in. Again, great college there, very strong entrepreneurial ecosystem, and also very close to skiing to Telluride and to a lot of the mountain rest resorts in the Southwest. And then we're building in some other parts of the state that are less well known, but have similar type of tailwinds.
That's great. So I want you to imagine now, Stephanie, that you're talking directly to a policymaker
Yeah.
who needs to make a decision on whether or not he or she supports the OZ legislation or OZ extension going forward. How would you sell the OZ program to that individual? And if I could lead you a little bit, what positive impacts primarily have your projects had on communities so far? And would those projects have been as impactful but for Opportunity Zone funding?
Well, I think there's two things I would say. One, we wouldn't have existed as a fund unless I'd had a captive audience looking for my types of investment. And the incentive really gave the opportunity for new intermediaries like me to come into the market and say, I'm going to build my market around taking advantage of this incentive and impacting the communities in a beneficial way. So we think that absent the OZ investment, many investors like us wouldn't have come into the market at all. If you kind of first and full stop. And as I've said, you mentioned there were so many fits and stops across the market, but it still had unbelievable success from an investment into the census tracts, these 8,700 census tracts that were designated across the US. And there was a Novogradac conference last week I was listening to. It was in the tens of billions of dollars. And I can't remember the exact number, but it's been an unbelievably successful investment. Now, are all of those investments positive for the communities? I can't say, but you have to know that absent this incentive, the vast majority, the super majority of those investments would not have happened. For us, the housing that we're building has gone so much faster than it otherwise would have. It exists when it otherwise wouldn't have. We kicked off in Grand Junction. We were the first in to really start investing in opportunity zones there. And now there's a lot of people behind us doing the same thing, which we think is great. And we think that there needs to be more over time coming in and incented in this way that where investors will let you underwrite to a return they otherwise wouldn't let you underwrite towards, and particularly holding it for a long period of time. So I would say one, it's a really brilliant policy. It has its flaws, like all policy does, and I think many of those are being addressed in some of the potential upcoming legislation that we're hoping is passed. And we're hoping it's passed because we think the market needs more time to percolate, particularly against all the fits and stops that we've had in the background.
Absolutely. Well, I'll ask you more about the legislation toward the end of today's episode, but wanted to turn my attention now to your time prior to joining 4 Points Funding. You were in former Colorado Governor John Hickenlooper's office, and you were responsible for nominating the opportunity zones in Colorado. Was there anything unique about your state's approach to doing that?
Well, I think we had 90 days, maximum 120 days to make it.
It's a very quick turnaround time.
It was
right?
a very quick turnaround. So I don't fault any of the states in what they did, but we kind of looked at this, taking a step back, and Governor Hickenlooper is actually really catalytic in this. He said, listen, let's start with the end in mind. Let's say this incentive is meant to catalyze things that otherwise wouldn't occur on the positive way. So let's take a look at we had 500 eligible census tracts. Take a look at all of them and just start indexing them based upon investability, adjacent infrastructure, and then on the flip end of that, distress, and really look at where are we going to be able to have a Goldilocks impact on a particular census tract. So for example, there are many eligible census tracts where the train had already left the station. They were already on a high path to growth, already a lot of investments coming in. And this actually would have just fueled a fire that was already burning really, really hot. We eliminated those. We essentially said, hey, we've seen in the last 5 years this kind of growth rate. Even though in 2010 these census tracts were distressed, we've seen them move out of that. So let's eliminate those. On the flip side of that, there were a lot of census tracts that had zero ability to attract any capital. I mean, nothing that we could actually think of or even make up in our minds. And so we essentially weighted those using this index pretty low. And then we looked at the rest of the census tracts, and we just stacked ranked them based on the way the algorithm, it's not quite an algorithm, the index application was applied. From there, we then did a lot of qualitative interviews across the state with county commissioners, municipal leaders, enterprise zone managers, where there was a lot of overlap, and essentially said, what would you do with this? How would you use it? How would you figure it out? And that moved things around a little bit. And mostly because the state had a strategy of really trying to continue to accept population growth without overcrowding. Dispersion across the state of population was a very strong kind of thing on everyone's mind, we thought about how do we move people into the more remote markets, and I'll call them rural markets, but these aren't tiny remote markets as the way you think about it. Move them more across the state so as to be able to continue to accept the population growth without the overcrowding that can exist in high dense urban areas. And so we shifted some of the zones into the rural parts of the state that had high investability index scores.
Oh, that's
And
great. I
that's how we
know.
did it. Yeah.
Yeah, your state certainly gave a lot of thought to the nomination process, probably more than a lot of others did. I know that EIG held you guys up as a star child, so to speak, star pupil under the
Yeah.
OZ program. So great work there that you and your team in the governor's office did way back in, I guess it was when the beginning of 2018.
2018,
Yeah,
2018, right after the 2017 Tax Cut and Jobs Act was passed. And by the way, EIG, I can't say enough about the work they've done in helping to catalyze this incentive and continuing to do that. So they were also really thoughtful with us because again, we had a very short period of time. So it wasn't just our own thoughts going into this. We had really great people helping us do that as well.
absolutely. No, EIG is fantastic. I
Yeah.
think my viewers and listeners probably agree if they're familiar
Yeah.
with their work. Oh, let's move along to opportunity zones. Who's investing in them? I guess question for you: are opportunity zones becoming more and more institutionalized as the marketplace matures? Do investors really understand how to utilize OZs yet, or does a huge gap still exist? A huge knowledge gap? What
I
are all
think
your
there,
thoughts there?
yeah, no, I think there are still big pockets of knowledge gap. I was on the phone with an investor on Thursday of last week who I was introducing opportunity zones for the first time, and they had a fairly large game they were working with. Um, Most of our investors are high net worth individuals that have that just that where tax management is part of their investment thesis, and what they
Mhm.
do. And this is a really good way to blend, kind of tax efficiency with real estate investing in a way that goes beyond what a 1031 exchange would do or other kinds of real estate development would do. And so I think that it feels to me like the whole market knows about opportunity zones, but I'm surprised every day when I talk to investors who are just getting to understand it, even accountants, even very, very highly qualified. So it just takes. I mean, this is not something there's been a big brand campaign rolled out in the US, where people are seeing this over and over again. So it absolutely is in the pockets of investors we're working with. Yes, it's becoming more well known, but there's still a large swath of the population that doesn't understand it, that could benefit from it. So I think there's a lot more room to go. Um, and the kinds of investors we're seeing, as I mentioned, mostly high net worth individuals or other funds that have kind of mission aligned or thematically asset class aligned targets that come in alongside us. We do that as well.
Right. We saw a lot of I don't know, something you just said made me think we saw a lot of commercials for crypto during last year's Super Bowl. Maybe we need a one or two opportunity zone commercials for the Super Bowl coming up this
Yeah,
February.
maybe that's right. I don't think that we're gonna it's again, crypto can probably at some point will hit every point on the tail of the consumerism. I'm not sure opportunity zones will, so maybe there's not the real benefit to do that, but I would like to see it become more um uh, commonplace, a common understanding of how people use it, and mostly because when anything's new and it seems like and it's getting headline news around it's just about making the rich richer or doing things, a lot of the
Mhm.
benefits are lost in the noise, and people don't want to share. It's not as interesting to share the positive benefits. It's lots more interesting to talk about the nefarious work that goes on in all those evil people. And I think the longer time we have, the more obvious it's going to become the positive impact this has had. So I think that we just got to keep on doing the work we're doing. And again, we'll talk a little bit about this in a minute, but I'm really, really hoping that the legislation that is, it's been proposed is enacted.
Yeah, absolutely. Well, I'm trying to use this podcast platform as one small voice in the
Right.
noise to try
Good.
to push some positive stories forward. Well, let's turn our attention now to legislation for the last few minutes of our time together here today. Stephanie, what are some, well, we talked about it a few minutes ago, but what are your overall thoughts on the legislation, and I know you're hopeful that it will pass. When do you think it might? And by the way, for the record, we are recording this toward the let's see, where are we? We're in late October.
Late
We're
October.
a couple weeks away from election day, so
Yeah.
I'm not exactly sure when this episode might air, but that's when we're talking right now.
Well, I'm hopeful, although I could not handicap this. So I'm hopeful that it passes before the end of the year, potentially even in the lame duck session, but I don't know enough about what's going on day to day on the Hill to say whether that's possible or not, or probable. I've also been monitoring quite a bit with the help of some of our partners, and it seems like the modification itself has bipartisan support. I like that it has reporting requirements which are on the funds. It is not it's not a standard that you have to operate against. It's just you have to tell people what you're doing with the fund. We think it's very positive. It does eliminate some of the opportunity zones that maybe don't really need the catalysts anymore, and it gives the states the opportunity to replace those. And most importantly, it just gives us a little bit more time. So it just delays the expiration of the investment period, the starting investment period, and it gives the time for the market to form a little bit more. I think that kind of iteration on any policy is both natural and very, very good. Like I said, I hope that we could see it before the end of the year. Whether that's probable, I couldn't say. If not then probably towards the beginning of next year.
Right. Well, yeah, hopefully it does get passed sooner rather than later. Fingers crossed. Stephanie, it's been great speaking with you today. Thanks for all of your insights. Before we go, if we have any listeners or viewers out there who want to learn more about you or what you're doing at 4 Points Funding, where can they go to learn more about you?
Sure. If you go to 4pointsfunding.com, that's where our website that has all of our funds, our current fund we're raising for, as well as all of our projects and what we've invested in. A little bit about us as partners. We now have close to 20 people on the team, and we'd love to have you come visit the site and hear from you anytime. And really appreciate the time, Jimmy. It was great to talk to you.
Fantastic. And for our listeners and viewers out there, as always, I will have show notes available for today's episode at opportunitydb.com/podcast. And there I'll have links to all of the resources that Stephanie and I discussed on today's show. And also, please be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. Just search for Opportunity Zones podcast. Stephanie, again, it's been a pleasure speaking with you today. Thank you so much for taking the time.
Thanks, Jimmy.